Welcome to Learning Unit 1 of Financial Management 3A, right? And Learning Unit 1 is entitled The Role and Environment of Financial Management. Now, as you should well know by now from your Financial Management 2A, right, which I believe you completed or at least attempted last year, financial management forms the backbone of an organization, right? And it is because it is intertwined with all the other departments that you find within the business, whether it be marketing, whether it be manufacturing, whether it be operations, and so on and so forth, right? It is involved in all the day to day runnings, right, of the business because all these departments, right, in order for them to achieve or fulfill their objectives, do require some sort of financial aid or assistance or finances in general. All right. So you'll find that finance interacts with all departments because it is involved in the planning, managing, and allocating of all business funds. Right. As we move on to the next slide, they actually tell us here that finance describes the study, creation, and management of money. All right. That's a very general, broad stroke definition. But if we look at it from a business context, it says financial management involves the management of funds of a business to ensure that the business objectives are met. The focus of a financial manager would be to achieve the optimal balance between risk, profitability, and shareholder maximization. How does it strike this balance, or how does financial management achieve this? All right, through three important decision making areas. There's the investment decision, there's the financing decision, and then there's the dividend decision. Now, if we're to quickly chop up what that actually entails when looking at the investment decision, here we're basically speaking to identifying investment opportunities, evaluating these opportunities, doing valuations on these opportunities, and then doing the financial modeling techniques to establish which projects the business should obviously take advantage of or invest in. Then financing decisions involves determining how the investment decision should be funded. Should we fund this through shareholder funding? In other words, equity, all right? Or should we use short term or long term borrowing, all right? Or alternatively, should we rather use retained earnings from the business? All these decisions need to be made by your financial manager, okay? And then dividend decisions. This one's pretty straightforward. How much of the profits the owners reward, of course, for undergoing or taking on risk and pursuing or attempting to um, engage in business. How much of the profits should we pay out to the shareholders, right? If at all pay out anything. So when we talk dividend decisions, we immediately talking about your retained earnings. How much retained earnings should we have, or how much dividends should we pay out? Should we pay out everything? So these are the decisions that the manager needs to understand um, and then make this decisive decision on in order to balance the relationship between risk and profitability for the purposes of wealth maximization. Okay. Then here they're just highlighting the primary activities of a financial manager. Okay. The primary focus is the acquisition, financing, and management of assets to ensure optimal utilization of shareholders' wealth is maximized. Okay? Right. Just saying the same thing, different set of words. And here they're just encouraging that in order for a financial manager to effectively and efficiently do this, they need to have a sound knowledge and understanding of the business and be able to take into account the possible financial consequences of making business decisions. All right? Possible financial consequences of making business decisions. Primary responsibilities or activities include financial planning and analysis. I'm sure just from what we have covered thus far, you can already see how much planning and analysis, forecasting, budgeting would be entailed in the financial manager's role. In addition to that, we've spoken on investment decisions. All right. All right. Should we purchase or sell the property uh, that we currently occupy? Should we purchase a new one? Should we sell any property, plant, and equipment? Okay, because it's becoming obsolete, all right, or it's no longer becoming conducive for the functions of the business. Okay, should we do a trade-in? How should we go about this investment decision? Financing decision. What is the most cost-effective source of funding? In other words, the cheapest, okay, so that we have a bigger return on the application of the capital that we have managed to source. Okay. Then here we're just looking at other activities, other responsibilities that fall under the scope of the financial manager's role: cash management, relationship management, dividend decisions, risk management, okay, financial reporting, okay, management accounting, tax management, and then obviously your asset allocation. Okay, what are the different assets that we are invested in? This we can skip. Okay, and then we get to the big overarching goal of your financial manager, the key objective of the business and the financial manager: wealth maximization. Okay, now here they're just talking to the fact that, believe it or not, the key objective of a financial manager is not profit maximization. It is actually wealth maximization. Okay? And the reason why we emphasize this now, we're not saying that as a financial manager you should totally neglect being profitable, but we're saying that a financial manager's role should be more long term oriented than short term oriented. We need to look beyond just making profit and actually look to wealth maximization. Timing of returns for the business. Okay, here now they're distinguishing between wealth maximization and profit maximization. The timing of returns for the business. Profit maximization does not take into account the amount of time it will take for profits to materialize into cash. As we all know at this point or this juncture, the fact that you have made a profit doesn't mean that that's the money sitting in the bank. Okay, that profit may not have turned into cash. Then cash flows. Okay, here we're talking to the fact that profit maximization ignores the timing of dividend payments to shareholders. Okay, then finally, risk. Profit maximization does not take into account the risk factor. Okay, accounting profits can be subject to creative accounting. Okay, by understating costs and overstating revenues. Okay, then the next part of this very same slide, they're just emphasizing that profit maximization is typically measured by your earnings per share of the business. Okay, earnings per share, an accounting measure, does not take into consideration the timing of returns, cash flows, and risk. Okay, while a very good measure, okay, it is more profit orientated. All right, it is more accounting orientated, which is not a bad thing, but we just need to understand these things and understand their value add in our role as a financial manager. Note that earnings per share is usually considered a good indicator of the health of a business and a measure of the potential for future returns. As such, there is, in many cases, a good relationship between the movement in the EPS number and the movement in the share price. Now, switching over to shareholder wealth maximization. is usually measured with reference to the business's current share price. Unlike earnings per share, the share price does take into consideration market expectations, the timing and magnitude of cash flows, and believe it or not, the risk of the business. Okay? So, in other words, a financial manager should be more preoccupied with the actual share price of a business than the earnings per share of the business. Okay? All financial decisions made by a business will have a direct impact on the share price. Therefore, one of the financial manager's key objectives is to consider all these projects and make decisions that will possibly, positively affect the share price. Okay? Because remember, the key objective or goal is that of wealth maximization. So, how then do we best see if we have increased shareholder wealth? And this is where the economic value add now comes into place. Okay? Right. So, okay, so here they're just speaking more to why we don't just look at the financial performance of a business over a period of time and then discuss whether it made a profit or a loss and then say this would be a good business to increase shareholder wealth. Okay, it says, let's put this question into context. I'm looking at the last paragraph on this slide. An entity requires capital funds to expand and maintain its operations. This capital is provided by equity holders and or lenders. So we basically were saying the shareholders will provide capital, and at the same time, they could potentially get capital from lenders, other financial institutions, okay, who require a return on the investment in the entity. I won't just give you capital for no good reason. I'm expecting you to pay me back with interest. Consequently, financial managers have to recognize a cost associated to the capital they use and therefore must engage in financial activities that will earn a return higher than the required by capital providers, than the return required by capital providers. Okay, so the money that has been invested in the business needs to earn a return greater than the cost of that capital. Okay, right. Now, so once again, we have brought in this economic value added measurement to measure, to see, have we increased the capital employed, right? Have we added value to the capital employed by investors and by financial institutions in the business? Okay. Here it says the economic value added, EVA, measures the entity's ability to generate operating profits that are greater than the cost of capital. Okay, so it's not just about profits, but profits being greater than the cost of the capital used to generate those profits. Okay, EVA model is considered to capture the true economic profit of an entity and is based on the premise that an investment decision creates value when the entity's operating profits exceed its cost of capital. Okay, right. Now, one, accounting operating profit reported in the entity's financial statement necessitates certain IFRS adjustments to make thereto before being used in the EVA calculation. Okay, so there's certain things that we need to obviously adjust from our regular accounting financial statements, okay, before we can use the profits in the EVA calculation. That's what we're saying there. This is done to convert the accrual, right, based operating profit to a cash based operating profit, and to recognize expenditure as long-term investments in the statement of financial position rather than once-off expenses in the statement of profit and loss. Okay, so here the accrual basis basically says for the month of July, what was our profit? Okay, but here we're saying no, we want to convert that to a cash-based operating profit. Okay, and on top of that, we want to acknowledge that some expenditure, all right, is actually, such as marketing, for instance, is actually it recognizes a once-off cost, but that can be used to actually build the brand, which would then obviously provide, can be looked at, should I say, as a long-term investment in the business, okay, which would then increase our profits. All right, so here, the capitalized expenditure would then be amortized over the period during which the entity expects to derive economic benefit from such expenditure. Okay, so here now they're giving us the two ways in which we can calculate your economic value added. Okay, you've got your net profit, net operating profit after tax minus your invested capital times your weighted average cost of capital. That's what WACC stands for. Okay. The second formula that we can utilize to calculate EVA is your invested capital times your return on invested capital minus your weighted average cost of capital. You can use either one to get to the same economic value added. Okay. And then here now they're just breaking down and speaking more to what your net profit, net operating profit after tax represents, or what it stands for, or what it's all about, how we then calculate it. Okay. They also speak to the adjustments that need to be made before you can utilize your net operating profit after tax. Okay. So this you can get into when you get into exercises. I think it will make more sense then. Okay. But what is important is that non-cash accounting entries will need to be added back to the accounting profit. Okay. Then discretionary investment expenditures, okay, need to be added back to the accounting profit. When calculating the accounting profit, these costs are deducted in full in the year in which they are incurred. Okay, that's how we usually treat it. Those expenses are deducted. Okay, as these are likely to yield economic benefit over a longer period than the financial period in which they were incurred, we calculate EVA. When calculating EVA, these costs are capitalized and amortized over the period during which the company expects to derive economic benefit from such expenditure. Okay, right. So here they're also just going on to explain WACC. Okay, here we've spoken to net operating profit after tax, and here they're going on to speak on WACC. Here is the definition. WACC is the minimum average rate of return an entity must earn from an existing asset base to satisfy its providers of capital, both equity and debt. Okay? So this is the minimum rate of return that the company must meet in order to ensure that you are neither making a profit or a loss. A profit or a loss. Okay? It represents the average expected future long-term cost of company finances. All right. And this is when we are talking about capital financing, that is a combination of both debt and equity. Okay. And there in the center of the slide, you can see the actual calculation or formula for calculating your weighted average cost of capital. Okay. There I can see I've written the ROIG. That's just an error. It should be ROIC, which is return on invested capital. Okay. So take the time to read through this. I'm sure it will be of value. Okay. To understand those various components. You understand those various components, it will be easier to definitely calculate your what do we call this again? It's skipping my mind. The EVA. Yes, the EVA. Economic value added. Okay. So what's important here is under the NB. All right. So under NB, it says investments within EVA that is positive, okay, will create value and will thus increase shareholder wealth. On the other hand, investments with a negative EVA will erode shareholders' wealth. In other words, it will actually deplete, it will actually diminish shareholder wealth. It is obvious that an astute financial manager would elect to proceed with investments with a positive EVA. Because, in other words, what are you achieving? You are maximizing or you're at least growing shareholder wealth, which is exactly our main overarching goal. And then here they just give us an illustration. Okay, so earlier in the slide, they were basically asking if a business has a net profit of 17 million rand. Once you just hear that, automatically you assume the business is doing well. 17 million rand in profit, you know, just by the magnitude of that number, we think the business is doing well. However, EVA says no, we need to not look at the accounting profit of 17 million, but rather we need to look at the capital that was employed and compare it with that to say, has it actually grown past the WACC, the weighted average cost of capital, all right? The minimum amount that is required by the investors or the providers of that capital. Has it grown? Has the rate of return on this capital been greater than that of the weighted average cost of capital? That is what we are basically assessing with EVA. Okay, so here, to answer the question, assume that the entities, equity holders, and lenders provided a capital sum of 200 million and required 25% return on the capital. Okay, so in other words, 25% of 100 million, that's 25 million. 200 million, that would then be 50 million. Further assume the adjusted profit, all right? In other words, our net operating profit after tax is 15 million. Okay, all right. So after we've done our relevant adjustments, the profit has come down from 17 to 15 million. Okay, right. So then it says the EVA of the entity will be calculated as follows. So here's a practical illustration. Remember our formula. I like method one. I find it easier. Net operating profit minus your invested capital times your WACC. Okay. So 15 million minus 200 million times 25%. And voila, you get a negative 35 million. So by virtue of just seeing that this is negative, immediately you know this does not have a positive EVA. You calculate using the other method, you see it is exactly the same. You've got a negative 35 million. Okay? As indicated earlier, both formulas yield the same result. Okay? the entity's EVA is negative. This means that the entity, even though it has been reported a large positive bottom line in its statement of profit and loss, in other words, from an accounting perspective, it has shown a large profit, okay? However, it is destroying shareholder wealth, okay? Because we've got a negative EVA, all right? So in other words, we are not maximizing shareholder wealth here. This is a bad investment. This business is a bad investment, okay? Because we're not even meeting the weighted average cost of capital. If we were meeting the weighted average cost of capital, this would be zero, okay? We would at least have zero on your EVA. The large profit generated by the entity was not enough to compensate equity holders and the lenders for their capital, okay? To compensate the capital provided for the opportunity cost of investing in the entity and the risk they took by making their funds available to the entity. The entity needed to generate a net operating profit after tax amounting to 50 million. We calculated this earlier. I said 200, I said 100 times 25%, 25 million. 25 million. And then times 200, that obviously then I double that to get 50 million. We only made 15, okay? So you can see already the shortfall of 35 million, okay? So again, here we're just reiterating this business or these assets that we've invested in are actually diminishing shareholder wealth. Okay, so let's stop it here for a second, and then we will proceed in a little bit with the other theme that we must undertake in learning unit 1.